Hi there, welcome to Kneppy Invest. When deciding whether to buy into a company or not, there are many things to look for. Whether the company has a moat, a competitive advantage, what the competition is like, branding as well could be very important. Margins, so I do look at gross margins and whether gross margins are increasing through time, something as simple as that. One thing that is really difficult to determine is the quality of the management. And in a way, the quality of the management of a company is the most important thing in determining the long term success of that company. So, how do we determine the quality of a management team? And this is something I think is very important, but is one of the hardest things to do. So, in today's video, I'm going to focus on one sign of quality management. Now, there could be the argument that this is the most important sign. I think it is a very important sign, maybe not the most important sign, but definitely an important sign. So I'm going to talk about that, which is capital allocation. I'm also going to show you an example of a high quality ASX company that is doing wonderful things when it comes to capital allocation. And that company is Sequoia Financial Group. And when I'm talking about determining whether a company has high quality management, it's all about actions of the management team, not the words, all about the actions. And I'm going to talk about that as we discuss Sequoia Financial Group. So when trying to figure out whether management is good quality, high quality, or not so high quality, there's probably quite a few things you have to look at, because the CEO particularly is very important when it comes to setting or maintaining culture. And that's really important for the long-term viability of a company. CEO is also really stuck with the strategy or vision of that company. They are the ones who set that in the short, medium, even long term. But in this video today, I'm going to talk about capital allocation. In my opinion, this is one of the most important jobs of the CEO and management team. And to support my point that this is potentially the most important job of the CEO and management team, capital allocation, there was a book by William Thorndike who wrote The Outsiders, and he explored 8 exemplary CEOs and examines the nature of their success. It was named by Forbes as one of the most important business books by Forbes. And Thorndike found that the success of these leaders can be attributed to one hyper-focused practice: capital allocation. So we are sort of realizing that capital allocation is really important. I'll get to the definition, my own definition of capital allocation, in the next slide. But unfortunately, capital allocation is a skill that you can't really learn from many of the things that get the CEOs into that position. And this is a quote from Warren Buffett in 1987, and this is still applicable today. This is what Warren Buffett said: "The heads of many companies are not skilled in capital allocation. And it is not surprising, because most bosses rise to the top because they have excelled in an area such as marketing, production, engineering, administration, or sometimes institutional politics." So that means there's going to be a lot of CEOs, a lot of management teams out there that are not skilled in capital allocation. They don't know what to do. So determining whether a management team has their wares around capital allocation is really important to determine. Now, when it comes to the definition of capital allocation, there are a plethora of different definitions out there. All you have to do is Google the words capital allocation, and you can find how many different definitions they are. So I thought I'd just come up with the most simplest definition I could think of, and this is my own definition. So it might not be all-encompassing, maybe not complete, but I just wanted to really simple it down so anyone who is not understanding of what capital allocation means, they can come to a better understanding, and then they can Google capital allocations and expand their own understanding of what capital allocation means by looking at these other definitions. So it all comes down to what the CEO does with the cash generated by the business they are running. So this is also includes capital raising or money generated by capital raisings or IPO process. And a good way to look at this is just comparing it to every single household out there. We all make capital allocation decisions every single week. Almost, maybe not every single week, but every single fortnight, every single month. Well, the majority of households do. There are some households who run from week or fortnight to fortnight. But personally, so I generate a certain amount of income from my job. And at the end of the fortnight, I have this spare amount of money after I pay, well, I don't have any debts left, but after I pay for food, petrol, all those sort of things, pay for fun things like entertainment, I have a certain amount of cash left over. What do I do with that cash? That is capital allocation. These are some of the things that the CEO of a company can decide to do with the cash generated by the business. Capital expenditure or research and development. So they're thinking long term, how do we grow the company over the next 5, 10, 20, even 50 years if they have that amount of foresight. Acquisitions. One of the ways a company can grow is from acquiring other companies, paying dividends, paying off debt, or share buybacks. So whenever a company generates all this money, they have to decide what to do with that money. And you'll see a lot of these decisions made by management. And sometimes these decisions do not pay off at all. And I'm thinking of Slater and Gordon here, going back to 2015-16, when they decided to acquire that English law firm. So that was an acquisition decision with the money the company generated through the business. Maybe they also went into debt, and that was an absolute disaster. So all these decisions made by the CEO, what they want to eventually do is increase shareholder wealth. You don't want to do, or they don't want to do the complete opposite and destroy shareholder wealth. They want to get as much value for shareholders as possible through these decisions. Now, something I should mention here is a lot of these decisions by management should be influenced by whether they think the company they are running is highly overvalued, not or fairly valued, or completely undervalued. For instance, a company's management should not be doing share buybacks when the company is completely overvalued. They should be doing the complete opposite. They should be doing share buybacks when the company is completely undervalued, because that's how they create the best returns for shareholders. Acquisitions. So if the company is completely overvalued, you want to fund acquisitions by capital raisings, not through debt. And the complete opposite, if they do an acquisition when the company they think is undervalued, they should be doing that through debt and through cash on hand. So determining whether the company is overvalued or undervalued is actually very important for a management team as well. Now let's have a look at an example of a company that I think is high quality, simply because of some of the decisions they made, which they revealed in an announcement to the market on the 4th of May, 2022. This was a company called Sequoia Financial Group. Now, for full disclosure purposes, I'm a shareholder of this company. One of the reasons I am a shareholder of this company is because I do think they are undervalued, and because I think management is pretty high quality. And this announcement they made backed up my realization that this company management team is high quality. So the title of this particular announcement was Market Update and Commencement of Buyback. So I'm going to go through certain points of this announcement and see what they're doing when it comes to capital allocation. So this announcement is all about capital allocations and the decisions the management team have made. So they started off in this announcement by confirming guidance provided the half year that they are on track for revenue in the range of 130 to 140 million. And they confirmed that EBITDA in the second half will exceed the first half, with financial 22 expected to be the top end of a range between 12 million and 13.5 million, or approximately 10 cents per share of operating cash flow before tax. They're trying to say at this point in time that they think the company is undervalued, and that is very important when it comes to capital allocation decisions. The company then mentioned that they're still seeking out acquisitions. And a company can make acquisitions even if the company's value is under or over what it should be, but it's just the way they acquire. How do they acquire these companies? Is it through capital raisings or is it through debt or the cash the company has? But given the current share price weakness, so they do think the current valuation of the company is lower than it should be, the company has decided to cancel the dividend reinvestment plan for the remainder of 2022. I'm a little bit torn about this one because I do think the dividend reinvestment plan is something that is a reward to current shareholders to be able to put their dividends and buy more shares at lower valuations. But I understand where the management is coming from. This is sort of like issuing new shares, and you don't want to issue new shares if you think the company is currently undervalued. That's probably the last thing you want to do. And it's the last thing you want to do because, in a way, you're unfairly diluting shareholders by issuing shares that are lower than it should be, if that makes sense. And then in the next part of the announcement, the company will also look to use cash and debt for funding acquisitional growth in the shorter term, rather than using the company's shares, which are currently priced by the market on an enterprise value multiple of between 5 and 6 times current financial year 22 cash flow forecast. So again, if they're going to do acquisitions, they're going to use cash and debt, not do capital raisings, because that means you're going to be issuing shares at a lower price than they believe is fair valued. And they use some numbers here to say, we think the current shares are lower than they should be. So the company's management right now is looking at the valuation of the company. They think it's lower than it should be, and they're deciding on capital allocation decisions based off where they think the valuation of the company is right now. So they're definitely heading right down the right path. They are thinking about this, and this tells me this company's management is high quality. And then it gets even better. The directors are of the view that it is in the best interest of shareholders to undertake further capital management by conducting an on-market buyback program of up to a maximum of 13.1 fully paid ordinary shares commencing 25th of May 2022. The buyback. When a company's management thinks the valuation of the company is lower than it should be, one of the best things they can do is a share buyback, buying back shares of the company when it's undervalued. That's a great capital allocation decisions. I have seen a lot of companies decide on share buybacks when the company's shares are overvalued. Now, this can be a subjective opinion, whether a company is overvalued or undervalued. And if we go back, I think it was about 10 years ago, maybe not that long ago, but about 8 years ago, CSL was actually doing some share buybacks when I thought the valuation of the company was higher than it should be. So I thought that was a bad capital allocation decision by management of CSL back then. But the shares of the company of CSL have actually gone up since then. So maybe it wasn't a bad decision in hindsight. So this is a great decision by Sequoia. They see a suppressed, depressed share price, and they have decided one of the best things they can do for shareholders is a share buyback. To be honest with you, this announcement from Sequoia Financial Group on the 4th of May, was one of the best announcements I've seen from a company I own for a long time. And a lot of capital allocation decisions from other companies I own have been quite disappointing. There have been a few companies whose share price have absolutely tanked by 50% or more who have done capital raisings. And you want to raise capital when the share price is at its peak, where the valuation of the company is at unusually high prices. So if the share price of a company runs from 10 cents to $1 in like 1 month, that's when you want to do a capital raising, not when the share price falls from $1 to 20 cents. That is actually the worst time to do a capital raising. That's when you want to do a share buyback, that sort of thing. So these are things I'm always looking for. These sort of decisions are things I'm always looking for when it comes to determining whether a company is run by high quality management or not. If you do have any questions about anything I've mentioned in this video, if you completely disagree with me, I'd love to hear your opinion. Otherwise, I'm not a financial advisor if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.